You scrape together $60,000 for a house down payment, believing you are taking the ultimate step toward lifelong financial security. You lock that hard-earned cash into a physical foundation and quietly pray that your local neighborhood property values keep rising every single year. Yet if you had parked that exact $60,000 into a broad market index while renting, the compound math tells a completely different story. The single biggest hidden expense of buying a home isn't even the interest rate. It is the massive opportunity cost of your locked capital. From your very first day as an owner, upfront friction strikes. You sign the papers and immediately lose thousands of dollars in closing fees. Between loan origination, title insurance, and transfer taxes, 3 to 6% of the purchase price vanishes into thin air before you even move in. That means thousands of your precious down payment dollars never touch your actual house equity. They disappear directly into the lender's pocket as unrecoverable friction. You hand over your cash, but your liquid emergency cushion is now completely trapped inside drywall and shingles that cannot easily buy groceries. Society repeatedly tells you that renting is throwing your money away, instilling a deep sense of guilt every single month you write a rent check. But dead cash locked in a foundation generates zero cash flow, cannot compound on itself like shares of the world's most productive businesses. Let us set up a fair mathematical experiment between two identical financial paths over the course of an entire 30-year working career. In Path 1, you buy a $400,000 house with $60,000 down. In Path 2, you rent and invest that exact capital. Most people assume the homeowner automatically wins this race, but real estate does not magically defy the cold laws of historical financial math. When you examine over 100 years of documented market data, the actual appreciation of residential housing looks shockingly different from the popular marketing myth. Nobel laureate Robert Shiller tracked a full century of American home prices, and his mathematical discovery completely shatters the illusion of housing wealth. When Yale economist Robert Shiller compiled over a century of United States housing data, he uncovered a reality that shocked the financial world. You often hear older relatives brag that they bought a home for $30,000 that is now worth $400,000. That enormous price jump looks like pure financial genius on paper, but your eyes are being tricked by the optical illusion of inflation. When you adjust for inflation using official economic data, American home prices grew at less than 1% per year in real terms. That means for an entire century, physical residential real estate barely outpaced the rising cost of everyday goods like groceries and fuel. Meanwhile, broad stock market index funds historically delivered an average real return of roughly 7% annually after subtracting all inflation. A 1% real return versus a 7% real return may sound modest, but over 30 years the difference is utterly staggering. Your $60,000 compounding at 7% grows to over $450,000 in pure, liquid purchasing power. So why do so many homeowners passionately believe their house was the greatest investment they ever made during their lifetime? Because human memory conveniently forgets all the cash poured into new roofs, broken plumbing, property taxes, and 3 decades of mortgage interest. If you buy a house for $400,000 and sell it for $700,000, you did not make $300,000. Once you subtract 30 years of unrecoverable holding costs and interest, your actual net investment return often shrinks down close to zero. Your primary residence is a wonderful personal shelter and a lifestyle choice, but mathematically it functions far more like a consuming liability. When you rent, your monthly payment is the absolute maximum you will pay, but your mortgage payment is only the bare minimum. To truly see why homeowners bleed cash every month, you must examine the 3 phantom costs that real estate brokers never mention. The first phantom cost is property tax, an inescapable recurring fee that means you never truly own your home free and clear. Even after paying off a 30-year mortgage, stop paying your annual property taxes, and your local government will quickly seize your house. Phantom cost number 2 is homeowners insurance, a mandatory expense whose premiums have surged across the country due to escalating replacement costs. The third and most destructive phantom cost is physical maintenance. Wood rots, roofs degrade, and modern appliances fail every single decade. Financial planners recommend budgeting 1 to 2% of the home value annually, meaning an extra $4,000 to $8,000 every year. When the central air conditioner unexpectedly fails in the middle of July, you cannot call a landlord. You pay $10,000. This brings us to the most vital concept in real estate math: unrecoverable costs. Money spent that you will never see again. When you pay $2,000 in monthly rent, your unrecoverable cost is obvious. Exactly $2,000 is gone forever. Now look at a $3,000 monthly mortgage payment. $500 goes to taxes, $200 to insurance, and $400 to maintenance. On top of that, $1,500 goes straight to mortgage interest, meaning $2,600 of your payment vanishes completely. In this scenario, the homeowner threw away $2,600 in dead money every month, while the renter only threw away $2,000. Only $400 miserable dollars out of your $3,000 mortgage check actually built real equity in your home. So why does almost your entire monthly payment go toward interest during the first decade? The answer lies in loan amortization. The mortgage formula was deliberately engineered so that the commercial bank collects almost all of its guaranteed profit before you build equity. When you inspect the front-loaded amortization curve up close, you will see exactly why moving every 7 years quietly destroys your wealth. You open your first monthly mortgage statement expecting to see your loan balance shrink significantly. Instead, you stare at a shocking reality. On a $340,000 loan at 7% interest, your monthly principal and interest payment is $2,260. But in month 1, $1,980 goes straight to bank interest. Only $280 touches your actual loan balance. That means 88% of your payment in year 1 is pure unrecoverable profit handed directly to the commercial lending institution. Why? Because mortgage interest is calculated against your entire massive starting balance, front-loading bank revenue long before you build any meaningful equity. After 5 full years of making on-time monthly payments, you have paid over $115,000 to the mortgage company. Yet your original loan balance has only dropped by less than $20,000. Nearly $100,000 vanished in interest alone. Here is the devastating catch. The average American homeowner moves every 5 to 7 years according to official Census Bureau housing data. You pack your moving boxes, sell your starter home, and immediately take out a brand new 30-year mortgage on a slightly larger house. By doing this, you instantly reset the amortization clock right back to year 1, stepping onto an endless cycle of front-loaded bank interest. If you stay the entire 30 years, you will pay over $470,000 in interest on a $340,000 loan. You paid more than double the price of the house just to rent the bank's money, while paying all property taxes and maintenance yourself. Now imagine keeping your $60,000 down payment liquid and avoiding that front-loaded interest trap entirely by investing in broad market indices. Instead of paying compound interest to a bank, you put compound interest to work directly for your own family's balance sheet for 3 decades. When you put both financial paths onto one cold 30-year mathematical ledger, the final wealth gap will change how you look at real estate forever. Let us lay out the 30-year financial ledger side by side, using verified historical economic data and identical starting numbers for both paths. In Path A, your $400,000 home grows at the historical real appreciation rate, reaching a nominal value of $1 million. That sounds like a massive $600,000 windfall until you calculate every single dollar you actually spent to keep that house standing. You paid $470,000 in mortgage interest, $300,000 in property taxes, and over $150,000 in ongoing maintenance. Add insurance and closing fees, and your total cash outlay over 30 years easily surpasses $1,300,000 of hard-earned income. When you subtract total holding costs from your final selling price, your real investment gain over 3 full decades is virtually flat or slightly negative. Now look at Path B, where you rented a clean apartment and deployed your $60,000 down payment into a low-cost market index. Without adding another penny, that initial $60,000 investment compounded at historical market returns grows to nearly $500,000 real dollars. Furthermore, because your monthly rent was cheaper than the homeowner's total unrecoverable costs, you invested an extra $400 every single month. That monthly investment stream compounds into an additional $500,000, pushing your total liquid portfolio well past $1 million in purchasing power. You end 30 years with over $1 million in pure, liquid assets that generate daily dividends, compared to one single aging brick house. If you need money in retirement, selling $5,000 of index shares takes 2 seconds. Selling a house takes months and costly broker commissions. You realize that the renter did not throw money away. By renting space and investing capital, they built superior, flexible, stress-free wealth. If the cold math favors disciplined investing so heavily, why does society constantly shame renters and demand that everyone buy physical real estate? Because homeownership is the lifeblood of a massive trillion-dollar industry that profits directly every time you sign a 30-year mortgage contract. The moment you sign that 30-year deed, a massive ecosystem of financial intermediaries celebrates, because your long-term debt generates their immediate guaranteed income. Real estate agents pocket up to 6% in transaction commissions, meaning $24,000 disappears from a $400,000 sale. Mortgage lenders collect lucrative origination fees on day one, then bundle your debt into mortgage-backed securities sold to institutional global investors. Local governments rely on your annual property tax reassessments to fund municipal budgets, guaranteeing a steady perpetual revenue stream from your front yard. Home improvement retailers, contractors, and furniture companies depend on your continuous repairs, extracting thousands more from your checking account every season. This relentless cycle creates the classic trap known as house rich and cash poor, where you live in a valuable structure while barely surviving. Behavioral economists Sendhil Mullainathan and Eldar Shaffer proved that financial scarcity acts like a cognitive tax, severely degrading your daily decision-making abilities. Nobel laureate Richard Thaler identified mental accounting, where you mistakenly view illiquid home equity as safe money while your liquid reserves dwindle. Every paycheck arrives and immediately evaporates into maintenance, insurance, and interest, leaving you stressed, financially fragile, and trapped in place. Meanwhile, the disciplined renter-investor maintains total liquidity, peace of mind, and the priceless flexibility to adjust to changing life circumstances. Labor market data shows that renters can move freely for major career promotions, while homeowners often decline lucrative raises due to relocation friction. Buying a house is not inherently bad, but locking your life savings into property without understanding the real math leaves you vulnerable. So how do you cut through the emotional real estate propaganda and calculate whether buying actually makes financial sense for your situation? You do not need a complicated 100-row spreadsheet. You only need one simple, elegant, 5-second mathematical rule created by financial economists. In the next section, you will learn the famous 5% rule, the definitive formula that levels the housing playing field forever. The 5% rule breaks down the total annual unrecoverable cost of homeownership into 3 simple, mathematically grounded components. The first component is 1% for annual property taxes, paid directly to your local municipality every single year. The second component is 1% for physical maintenance and structural depreciation, preserving the integrity of your physical building. The third component is 3% for the cost of capital, combining mortgage interest with the opportunity cost of your down payment. Add them together. 1% plus 1% plus 3% equals 5% in unrecoverable annual holding costs. To test any home on the market, multiply the total purchase price by 5%, then divide by 12 months. On a $400,000 house, 5% equals exactly $20,000 in unrecoverable annual ownership expenses. Divide $20,000 by 12 months, and your break-even unrecoverable cost is exactly $1,667 every single month. If you can rent an equivalent home for less than $1,667, renting and investing the difference wins mathematically. If renting costs significantly more than that threshold, buying begins to offer a distinct mathematical advantage for your long-term wealth. You now hold an objective mathematical filter in your hands, completely free from real estate sales pressure and societal shame. Renting is not setting money on fire. It is simply purchasing shelter services while keeping your productive capital fully compounding. Buying only makes mathematical sense when your horizon exceeds 10 years, your lifestyle values stability, and you accept the holding costs. You are no longer gambling your life savings on blind hope. You are making an informed, cold calculated strategic decision. In the final chapter, we bring all the threads together so you can take back control of your financial destiny. When you strip away emotional marketing, Buying a home is simply one of many lifestyle choices, not an automatic guarantee of wealth. Society conditioned you to equate a property deed with personal maturity, creating unnecessary shame every time you choose to rent instead. Now you see physical property for what it truly is: an expensive, illiquid lifestyle asset that requires constant capital to maintain. You understand that real wealth is not measured by square footage, but by liquid cash flow, compounding assets, and financial peace. When you rent and invest your excess capital, your money works silently for your future without middleman commissions or interest drain. Global business index funds compound 24 hours a day, generating steady dividends without leaky roofs, property reassessments, or costly emergency repairs. You sleep soundly knowing your emergency fund remains liquid, flexible, and completely untouched by unexpected $10,000 contractor bills. With the 5% rule firmly in your financial toolkit, you can evaluate any real estate market with cold, objective clarity. Lenders and brokers can no longer pressure you with emotional sales pitches, because you know exactly how the amortization machine operates. If you choose to buy a home, you will do so with eyes wide open, fully prepared for holding costs and time horizons. And if you choose to rent, you will do so proudly, knowing your compounding capital is building lasting multi-generational wealth. You have officially broken free from the most expensive myth in personal finance, turning confusing rules into your personal advantage. Decades from now, your future self will thank you for choosing mathematical truth over societal pressure and uncalculated debt. You now see the entire financial chessboard clearly, recognizing who profits from your debt and how to protect your hard-earned capital. You no longer blindly lock $60,000 into concrete and pray. You now master the real math, controlling your financial destiny.